The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Juliana Tatelbaum. These are your headlines today. The global bond rout settles for now, but concerns over the fiscal picture in major economies keeps the long end of the yield curve near multi-year highs. The CEO of Commerzbank tells CNBC markets should closely watch how governments respond.
I think in the moment we are not overly concerned, and I think it all depends now how things are developing. Is the government continuing their approach with the reforms?
Weaker than expected job openings stateside help lift bets for a September Fed cut and bring some added relief to bond markets. Fed chair candidate Christopher Waller tells CNBC he expects more easing to come.
I think we need to start cutting rates at the next meeting, and then we don't have to go in a locked sequence of steps. We can kind of see where things are going because people are still worried about tariff inflation. I'm not, but everybody else is.
And French President Emmanuel Macron hosts a coalition of the willing summit in Paris today as Ukraine's allies look to shore up U.S. support for prospective post-war guarantees.
Good morning, everyone. We spent our day closely looking at bond markets again amid some of the turmoil in recent sessions. The 10-year global bonds this morning, we've seen a little bit of settling down, and this is the picture this morning, no doubt helped by a Japanese bond auction. We'll get into that, but you can see peeling back on that 10-year JGB. Elsewhere, we're still in the green on the 10-year Treasury yield. You can see on gilts, we're a little bit lighter this morning. We've given back some territory on that yield, so that is a little bit of heat coming out of the market. And you can see on the OATs, we are still fairly steady morning session, but a lot wrapped up around that French story still. A quick look at the 30-year, the long end of the bond market. We are seeing at the 30-year in the U.S. market, again, fairly flat, fairly stable, but we are seeing that drop again in Japanese JGBs, down 0.75% morning session. Slightly higher on that gilt, though, and you can see the difference there versus that 10-year we just checked, so up 0.2% morning session, and on French paper that is fairly stable. We are closely watching the French auction of its long-term bonds today after borrowing costs climbed this week with the spread between the French and German 10-year hitting a 5-month high. It comes amid wider political instability in France as Prime Minister François Bayrou faces a vote of confidence on Monday. Meantime, as I mentioned, investor appetite for Japanese bonds was put to the test at Japan's 30-year auction this morning. But demand was broadly in line with the 12-month average as the sale passed off smoothly. Speaking to Parliament Wednesday, Bank of England Governor Andrew Bailey said investors shouldn't, quote, over-focus on 30-year paper since global forces are to blame for a steepening curve. But he did sound a word of caution on the rate path.
The path will continue to be downwards gradually over time because policy is still restrictive. There is now considerably more doubt about exactly when and how quickly we can make those further steps. That's the message I wanted to get across. Now, I think actually judging by what's happened certainly to market pricing since then, I think that message has landed.
Joining us now around the set this morning is Frederick Repton, who is a Senior Portfolio Manager, Global Fixed Income Team at Neuberger Berman, and Victor Hort, who is the Global Head of Credit and Equity Derivatives Strategy at BNP Paribas. Welcome to you both. Thank you so much for joining us. We are closely eyeing this auction today. This Japanese auction landed in the market, but it's the lowest demand since June. It comes in troubled waters, but I think there's a bit of a sigh of relief as we also look at the bigger picture. And this is just extraordinary. We had a bond market earlier in the year that was throwing effectively a tantrum around Liberation Day tariff policy, but now it wants the tariff revenue to conquer some of the debt and deficit situation. In addition to that, we've got the concerns around instability coming from Federal Reserve independence that has been questioned. So just to start for us, the perspective from your view, what is the major issue from here for the bond market, and do you think we have a problem?
Well, if I can focus on the corporate bond market for a start, I think there's a degree of bipolarism. On one hand, there's a lot of unease, obviously, about the volatility at the very long end of the government bond curves. And at the same time, some of the reasons why the corporate bond market is faring so well is because yields are so high. High yields does a number of positive things for the corporate bond market. It attracts demand, obviously, because of the yield and carry. It reduces supply because it's expensive for corporates to borrow heavily. And it incentivizes corporates to be pretty disciplined about their balance sheets and therefore deleverage and better ratings and so on and so forth. So the high yields that we have today have mostly been good for the corporate bond part of the market. And when you look at credit spreads, they are at multi-decade tight. But a spread is obviously the spread between the yields of one asset class, which is pretty defensive, and another asset class which has issues. The government bond side is the relatively riskier part of the market today. And I think that helps explain why credit spreads are so tight.
Which is a telling story, isn't it? And to that point, Frederick, come in on this, because we are seeing a market that wants this tariff revenue, because we know lurking, not just in the United States, but more broadly globally, concerns around debt and deficit and whether this is going to be something tackled by various governments. We've seen it in the UK market as well. So from your view, how big an issue is the debt deficit issue today?
Well, I think it's the number one issue for sovereign market investors, right? You look across the world. You start with Japan. On Monday, now we have the vote whether they should accelerate the vote on leadership for the LDP in Japan. That's clearly important. JGBs, if you look at the curves, we like to talk about the yield curve in Japan, in Germany, in the US, but actually if you look at the Japanese yield curve, it's the steepest one. There's a lot of risk premium in Japan being built in the long end, and that's because people are worried about the deficits. They're worried about BOJ not doing enough to tamper inflation there. Now, we have that on Monday. Then we turn over to Europe. Same thing in France. We got the no confidence vote in France, right? And then clearly we had back from school, I call it, for bond investors on Tuesday after the Labor Day. It was a record day of issuance in European bond market as a whole. It's been a record issuance of gilts this week with a syndication that was up from £8 billion to £14 billion. So there's been a lot of supply. It's important not to look at Tuesday price action and panic, but it's definitely on investors' radar. People are worried about deficits. People are worried about the political situation. We see now the UK budget was expected in October. It's been pushed back to November. That also makes the Bank of England's job quite difficult because the budget is going to come after the meeting, and this is the full forecast meeting. So lots to digest for investors. I think market had anticipated maybe a more benign environment following Jackson Hole, right, where we had opened the door. We heard Christopher Waller yesterday, I think really important, opening the door for multiple cuts over the next few months, as he mentioned in his speech. And so, you put that into context of bond markets opening, worried about deficits, lots of event risk. We got the benchmark revisions also on the labor market next week. So there's just a lot of risk on the horizon for bond market investors.
You've mentioned several different countries here. We've seen bond yields rise across the globe, whether it be France, the UK, Japan, the US. We've seen steepening in all these regions. Clearly, there is some uniqueness to each situation, but there's also this undercurrent of concern around debt, around deficits. How linked are these moves in your view? What do you make of the fact that each situation is unique, but they're all happening at the same time?
Well, number one is, of course, inflation. Inflation has been much more sticky than I think policymakers and market participants expected. So that's the number one issue. The second one is political instability everywhere, right? In the UK, I think people are worried about the fiscal situation. Japan, France, it adds up, right? It adds up. And so this is the main issue that investors have to face. We have to see where things are going. Now, if you look at commodity prices in Japan, for instance, there's a really interesting dynamic with rice prices that are going to roll off in October and November that could dampen inflation in Japan, and potentially the situation with regards to Japanese term premium could look very different come November, for instance. And so maybe that will help to alleviate some of the concerns that investors have.
Victor, you talk about the strength and the resilience of the corporate credit market, and you really nicely outlined the reasons for it. If we do see the Federal Reserve embark on a rate-cutting cycle, and to your point, Christopher Waller, now talking about multiple rate cuts here, what impact is that likely to have on credit markets?
Well, I mean, historically, it's been very bullish. It's basically Fed switching its reaction function and wanting financial conditions to be easy and therefore wanting risk markets to be high and effectively having the markets back. Here, of course, is this underlying tension in the long end of the bond market, right? Is this a central bank which is quietly sort of starting to tolerate a bit more inflation than it has historically? And that is something that you would see at the very first in the long end of the bond market. But it's not at all obvious that the first reaction to that kind of volatility is negative equities and negative credit markets. In fact, most of these situations historically where you have central banks that want to run things hot, the equity markets tend to like them and the corporate bond markets tend to like them too.
Where we could see the market show a little bit more concern is around the Federal Reserve independence story. And this just keeps rolling along. I mean, the latest where we got to was concerns around tax on Jay Powell, to a tax on Lisa Cook, to concerns around what happens with some of the regional governors next year, some of those appointments. We know that the market looks for stability from the central bank, from the US Federal Reserve. Does that have any implications for the corporate bond market, even though you sound somewhat resilient around your quarter of town? Does any of this catch up with the corporate bond market and whether there's willingness to take on more debt at some point for corporates?
Yeah, although it can be a very long sequence. And I do think that, the pressure on the Fed is pretty obvious. And it may not be a simple headline event where Trump fires Jay Powell. It may be that the institution itself starts to feel that the historical bipartisan political support for the Fed's mandate and price stability is starting to erode, and that they feel that maybe the price to pay for price stability in order to, pushing unemployment higher in order to really, really push prices down to 2% is just not a price worth paying. Maybe at 8% it is, but at 2.5%, 3% it is not. And so you're starting to, without any big headline events, see a Fed that's sort of shifting in that direction and cares a little bit less about price stability and a little bit more about the labor market. And as I said, that period can be very bullish for a risky market, even if maybe the end game may ultimately be problematic.
Yeah, that's fascinating around the tactical consequences. To me, Stephen Mirren, this is Trump's pick for the Federal Reserve. He was in a Senate confirmation hearing, effectively saying he would work to preserve the central bank's independence. But to me, it seemed like a hollow promise, given where he's come from and seen very much as a Trump lackey. You plug into the equation Andrew Bailey also warning about Federal Reserve independence from here. From your perspective, Frederick, what does it look like?
Well, it's been a rally from policymakers really to enforce independence of central banks, right? Around the world, by the way. So, there's always going to be some type of pressure, in particular, like Victor said, when yields rise, there will be some trade-offs for policymakers to make that may slightly deviate from the mandates. But yes, it is concerning, right? I think one of the expressions that people have had is the curve steepener and also the underweight in the US dollar. We're seeing the dollar decline quite significantly throughout the year. It could be one of the better vehicles for market participants to express this should we go down the route of less independence from the Fed.
Frederick, can I just get your view on the gilt market moves? We just had Andrew Bailey yesterday remarking that global forces are to blame for what's happening in the 30-year. Is that a fair assessment? Is it really global forces that are driving the long end up here in the UK, or is it what's happening domestically?
I think it's somewhat fair, right? Like we had this rise in long end yields, so clearly the UK curve has steepened in line with all the other curves, but if you look at the spread versus Germany, for instance, of course, there's expectations of a large issuance program in Germany. Really, in the second half of this year, they started to increase their issuance slightly. But the spread is about 200 basis points. I think over the last year, the peak was 230 basis points. It's come back slightly. But it seems like this 200 level is quite significant for those bond markets. So yes, there is some idiosyncratic risk. Look at sterling as well. So you have to look at rates and FX in combination. You can see that market participants are building up some risk premium, because if you look at euro sterling versus short-term rate differentials, there is now a risk premium baked into the sterling, and we see it from time to time. We saw, by the way, a very similar episode at the beginning of the year, right, where UK yields sharply rose 30 basis points, euro sterling rallied 2.2%, but then that was subsequently taken away. Right? So we could be in a situation like that. Again, I think it's important not to look at Tuesday with record issuance in Europe and think that the bond market is in trouble.
Yeah. Note of caution there. Can you just bring it together for us before we let you both go? 10 seconds each. Tactical opportunity for investors trying to trade this market. What do you think?
High yield bonds.
High yield bonds.
High yield bonds. They do very, very well in periods that are where central banks are running the economy a little bit hot.
Right. Frederick?
We continue to like yield curve steepeners, in particularly in the U.S. We also like an underweight in the U.S. dollar. I think there's going to be a lot of capital reallocation, lots of institutions considering their asset allocations as they go into 2026.
Thank you both so much for joining us for the great conversation. Frederick.
Our two Swedes, thank you.
What a way to start the morning. Frederick Repton, Senior Portfolio Manager at Global Fixed Income Team at Neuberger Berman, and Victor Hort, a Global Head of Credit and Equity Derivative Strategy at BNP Paribas.
Thank you.
Thank you.
U.S. job openings fell to 7.18 million in July, according to the closely watched JOLT survey, missing expectations. It's a level rarely seen since the COVID-19 pandemic and prompted bets that the Fed could cut rates more aggressively going forward. Investors are now turning their attention to private payrolls data due today. The ADP report is expected to show a softer print for August, with Dow Jones economists estimating an increase of 75,000 jobs. Analysts are also expecting a slight uptick in weekly jobless claims. Now, that comes ahead, of course, of the all-important non-farm payrolls report out this Friday. Meantime, Fed Governor Christopher Waller told CNBC there were a lot of factors weighing on the U.S. labor market at the moment.
I think there's a lot of other stuff that is driving the labor market down. And I do think it's all on labor demand. A lot of talk about immigration. It's all about immigration. But if immigration was just a decreasing labor supply and labor demand was stable, you would see wages starting to be bid up. You'd start seeing vacancies going up. We're not seeing that. So all the labor supply is doing is masking this declining, falling labor demand, which from a Fed's point of view is not a good thing. Our goal is not to say, hey, the unemployment rate is great while labor demand and job creation is falling. That's not what our objective is. It's maximum employment.
Waller has expressed support for the central bank to start a rate-cutting cycle this month, saying it has the flexibility to adjust the pace in future. It's worth noting that Waller is considered to be one of President Trump's front-runners to replace Fed Chair Jerome Powell. He was also one of the two Fed governors to oppose the central bank's decision to hold rates in July. The chair of the Council of Economic Advisers, Stephen Mirren, vowed to uphold the Fed's independence as well as its dual mandate of price stability and maximum employment. Mirren, who is President Trump's nominee for the open Fed governor role, made the remarks in his opening statement and submitted to the Senate Banking Committee ahead of his confirmation hearing today. Ahead on the show, we take a look ahead to the Nuclear Symposium as the summit marks its 50th anniversary. Plus, French President Emmanuel Macron hosts Ukraine's President Zelensky in Paris on the eve of a coalition of the willing meeting. With security guarantees firmly in focus, we'll have details. And we'll be joined by the Chief Investment Officer of Bitwise to discuss all things crypto. That conversation ahead at 8:45 London time.
Welcome back to the program. Well, the 2025 World Nuclear Symposium is taking place in London today as the summit marks its 50th anniversary. Key industry players are meeting to shape the future of the sector as interest for the renewable energy continues to grow. Uranium Energy Corp has launched a new subsidiary for the refinement and conversion of uranium, which says will make it the only U.S. company with end-to-end uranium processing capabilities. We'll learn more about why that is important in just a moment. Amir Adnani joins us, CEO of Uranium Energy Corp. Amir, great to have you with us. Good morning.
It's my pleasure to be with you. Thanks for having me.
So you're stopping into the studio before you make your way to the summit. This is the 50th year of this coming together. Policymakers, CEOs, financiers all coming together to try to talk about the future of the nuclear energy industry. What's top of mind for the industry at the moment as you come together today?
Top of mind is as nuclear energy takes center stage in the global energy policy and requirements, how does nuclear and how does the industry meet the targets? There are various pledges out there. We have a global pledge to triple nuclear energy by 2050. President Trump in the U.S. has come out and called for a quadrupling of nuclear energy in the U.S. by the same time frame. These are remarkable rates of growth, and the levels of growth that I don't think a few years ago anyone could have even anticipated. But when you look at these undeniable mega trends of electrification, decarbonization, digitization, it's quite clear that the baseload, safe, very reliable 24/7 features of nuclear energy are very much needed. And so for those reasons, what we're seeing and hearing at the conference is, does government carry the ball all the way to the finish line, or what kind of role do banks and financial players need to play? How does all of this need to get sorted out? Because ultimately, I don't think government has the fiscal capacity. You look yesterday, the other day, Morgan Stanley pegged the level of investment needed to realize this type of growth at over $2 trillion, right? So where does the fiscal capacity also come from? And I think the good news is, and yesterday we had our inaugural finance summit at the World Nuclear Association, and you had banks there, and you had investors there, and you had institutional investors there who actually see a very attractive business case for investing in the industry alongside government and alongside other industry participants.
Nuclear has been quite a contentious energy form in Europe, especially. How are attitudes changing? And you just cited the U.S. as one example of a country that is really doubling down on nuclear in a way that it hadn't before. But what about within Europe? How would you describe attitudes at the moment?
I would say that attitudes in support and favor of nuclear energy today are arguably at all-time highs. That doesn't mean that everyone has been won over. And there are, when you look at Europe, just go there first, you see a fragmentation, particularly in a country like Germany that's not really looking to move forward with nuclear. But at the same time, you look at France, you look at Sweden, you look at the UK right here as we're hosting the WNA, and it's a complete opposite. And again, it's this realization that if we want to address the issues around climate, and I've yet to come across a climate scientist in the last few years who doesn't recognize that we can't reduce the carbon issues and address reducing carbon without relying heavily on that low carbon, no carbon attributes of nuclear energy. So in the U.S., same thing. We've got this tremendous demand coming for AI, which means energy. And so again, when you balance that, when you balance where society wants to move and what it requires to do so while balancing climate concerns, nuclear checks the boxes necessary for that. So attitudes, I believe, are at an all-time high in favor of nuclear energy, and that's what's supporting the growth. It's one of the key pillars of the support that we're seeing. But at the same time, it's still an industry that's going to continue working to win even more people over.
A few industries have been really caught up in the psyche for voters, like nuclear. I mean, it's been fascinating on the back of the Fukushima nuclear disaster in Japan many years ago now. It was such a sea change where nuclear was just such a bad word for many people, particularly in Germany, for instance. But to see that mood change on the ground and with politicians. You mentioned Trump, and that is fascinating because we haven't spoken a lot on this channel about Trump and nuclear. What sort of green lights is the president giving the industry, and what does that mean for the rest of the energy mix?
What we're seeing with President Trump, a few months ago, we had his executive orders on nuclear energy to quadruple nuclear energy in the U.S., as I mentioned earlier, and to rebuild the nuclear industrial base, which means the fuel cycle, which means everything that goes into supporting a growing, thriving industry. But what's really critical about these executive orders, and when we talk about President Trump, it's that nuclear is enjoying this incredibly unique moment in the U.S. where it's got bipartisan support, and it's enjoying this bipartisan support. We were equally receiving support from President Biden during his administration in terms of, again, that realization that this issue is truly now, for the first time, a bipartisan issue in the U.S., which is so rare. I mean, think about what sector or topic you find in the U.S. where Republicans and Democrats both agree on.
Pretty much nothing at this point.
Yeah, and to your point on Japan, what's remarkable about Japan, and you're 100% right, in terms of obviously Fukushima was a very difficult moment, but we've seen even the public opinion polls in Japan turn in favor of nuclear energy. Once post-Russia's invasion of Ukraine, we saw a spike in just energy cost and again, this realization that not only do we want a source of energy that's sourced and reliable and helpful from a climate point of view, but we want it just on our own soil so we control it so we're not dependent on others' supply chains, especially if it's from adversaries.
The how is really interesting because what we've seen across Europe, very different approach. In France, small nuclear reactors, much more localized types of rollout. You mentioned the word rebuild. And, you know, that's quite different to the UK situation where we talk about extending the life of existing infrastructure, not necessarily a rebuild. So how would you characterize where the US market is at, whether it's the small reactors, big reactors, extended lifespan, you know, breaking new ground? Where are you at?
You know, it's a great question because, you know, over the last decade, the growth, whether it was big, small, or medium in building reactors, really came out of China. And China really led the world in growth. The US has finally decided to join the growth sort of component in the industry. And to your point, it's not just growing large reactors, 1 gigawatt reactors, but there's now this thriving new world of small and advanced modular reactors. Much smaller units, could be as small as 2 megawatts up to 100 megawatts or more. And there's an incredible amount of innovation coming into this. Several companies that have been formed, and the government is supporting it, technology is supporting it. And look, hyperscalers, the Microsofts of the world, the companies that are some of the richest out there, you know, from Amazon to Meta to Google to Microsoft. Microsoft just yesterday announced that they were joining the World Nuclear Association. That was a great addition to our membership base. These companies are voting with their wallets.
A quick word on safety, though.
Yeah.
Are there safety implications?
Nuclear has demonstrated over decades of history having the safest operating track record of any large form of power generation. And safety will always be top of mind for an industry, and the industry has a tremendous safety culture embedded in it.